The price of gold has surged recently, and in this video we'll look at the reasons behind that, but also what it tells us more generally about the economy, and also whether it might crash just as sharply as it's risen. Finally, we'll look at how investors can buy gold and whether I consider it's a good investment. This video is sponsored by NordVPN, an app that lets you securely connect to the internet across all of your devices. Let's begin with looking at why gold has risen so much. And if we look at the price of gold since 1970, and this is expressed in real terms so that the price is given in 2024 US dollars, you can see that there have been three spikes in the price of gold over this period. The first in 1980, and in fact gold is still in a drawdown since that peak. The second one in 2011, and the third one more recently in 2020. In fact, for all those three peaks, if we express it in 2024 dollars, all those prices were higher than they are today. But it does seem to be a pattern for gold that it spends lots of time being quiescent, it doesn't really do anything, and then it surges due to usually macroeconomic shocks. What's different in 2024 is there hasn't really been a big macroeconomic shock. There is geopolitical instability, that's for certain. There is an election coming up in the US, but it's hard to say that there's real duress in markets. In fact, stock prices, as I make this video, are still doing quite well. So what are the primary drivers of the price of gold? I'd say probably the most important one is the value of the dollar, and that's because the value of gold is expressed in dollars. So a high gold price is effectively saying that it's strong relative to the value of the dollar. Strong gold is weak dollar. Another important factor is real interest rates, because if you can earn a high rate of return in something which is very low risk, like US Treasuries, that's a toxic environment for gold, given that gold is a wasting asset and it doesn't generate an income. So high interest rates generally mean a low price of gold. And then finally, inflation is another factor which drives the price of gold, as it does with any commodity, because if a commodity is still useful, then it will track inflation long term. What we wouldn't necessarily expect is that it would beat inflation. Now, if you have our premium website membership, you'll have access to these trackers, one of which is a gold fair value model. Now, this gives you a crude idea of what gold should be worth based on those three factors which we discussed. And as we make this video, the model's forecasting that the price of gold is about 18% above its fair value. Given the strength of the US dollar right now, given the real 10-year US interest rate, and given the level of CPI. So if we just look at the divergence of the model from the actual price of gold, you can see that the divergence really kicked off in March of 2024. The model's fair price at that point started to go down, and the price of gold started to shoot up. Why did the model's forecast fall? Well, for two primary reasons. The first one was that real interest rates in the United States increased, and that pushes down the fair value of gold. That dragged the fair price down by about 4%, and then the dollar strengthened at the same time, and that wiped another 3% off the model's value for gold. So clearly there's some other factor at play here other than those three factors which we discussed. Now you might think that there's a huge amount of inflows into gold ETFs. There's lots of investor buying and that's pushing up the price. Well, if you look at the amount of money flowing into gold ETFs, which is a very common way of buying gold, in fact we've seen steady outflows for almost a year now. So while the price of gold has been steadily increasing, money's been steadily coming out of those ETFs. And the World Gold Council also has its own fair price model which tries to explain gold price movements. That includes factors like economic expansion, risk and uncertainty which tend to push up the price of gold, opportunity cost from currency movements but also from interest rates, momentum, if the price is going up it tends to carry on going up, and finally a factor which they call unexplained. And you can probably guess which is the biggest factor at the moment pushing the price of gold up. Yes, it's the unexplained factor. One possible source of demand for gold could be central banks. Now we do know that some central banks have been buying heavily. For example, the Chinese central bank added 160,000 troy ounces of gold to its reserves, and that was in March alone. If you're wondering how much that is in kilograms, it's just under 5,000 kilograms, and if you were to create that as a cube of gold, it would roughly measure 60 centimeters on each side of the cube, so it's quite a large amount of gold. And according to this Reuters story, you can see beside me, Turkey, India, Kazakhstan, and some Eastern European countries have also had their central banks buying gold. And according to data from the World Gold Council, if you look at the central bank buying in 2022 and 2023, it's been very brisk indeed. So this isn't something new. This is something that's been going on for some time, perhaps in response to weaponization of the dollar, as we'll discuss later. But it does seem as the most likely factor behind the rise of gold has been central bank buying, simply because these banks can buy a lot of gold. So what is this rally telling us about the US economy in particular? There's a nice graph here from Brad Setzer, who's a China watcher and an economist. And what he's showing is that China's holdings of US financial assets are roughly where they were a very long time ago. In fact, where they were 2 decades ago when China joined the World Trade Organization. And this is expressed as a percentage of Chinese GDP. Now, he explains that part of that reason for the fall is that the money was moved out of US assets and back onto the balance sheets of Chinese banks. That removed about $2 trillion worth of Chinese assets. But perhaps another reason for that fall is that China doesn't want the US to own much of its assets, because it could be that if it falls out with the US over trade, maybe after a change of presidency, then if that happens, it can't have its assets confiscated by the US. Because with Russia, for example, after it invaded Ukraine, a lot of its assets in foreign countries were frozen. Another reason why people might be getting worried about the US economy is US debt. There has been a report from the Congressional Budget Office, which is a politically neutral watchdog that looks at US debt sustainability. If you look at the projection of US debt relative to GDP, it's projected to rise very rapidly. Currently, it's at 100%, which is high by historic standards, but of course a lot of that came after the pandemic. The US spent about 10% of its GDP stimulating its economy, which has been very successful. US growth has been very good relative to the rest of G7, but of course it comes at a price, which is more debt outstanding. Now, normally the way to get out of a high debt to GDP ratio is to grow faster than your debt. However, the debt servicing cost in the US is now much higher because interest rates are simply higher than they were. So you might think the US could simply cut its expenditure and that way also reduce the growth rate of its debt to GDP ratio. That way there's less of a hurdle to grow out of the problem. However, if you break down US government expenditure according to whether it's mandatory or whether it's discretionary, a lot of it is now mandatory. Mandatory spending is not much less than 15% of GDP, whereas discretionary spending, which can be cut much more easily, is just over 6% of GDP and falling. So the US doesn't have a lot of fiscal wiggle room to decrease spending. A lot of its expenditure is locked in. And a lot of the discretionary categories are things which will come with a lot of political pushback. For example, cutting back military spending right now would be seen as a mistake at the moment, given what's going on the world stage. So what does this mean for the price of gold? Well, if US debt is unsustainable, then it's unlikely that the Federal Reserve would be able to keep rates high when the debt servicing cost becomes unpalatable and also unmanageable. That means that the Fed would have to cut and keep rates low. That in turn means that the toxic environment for gold, which is high interest rates, would go away. Plus worries about US debt would probably push people towards gold as well, and that's via the risk channel. So I think the rally in the price of gold is not telling us anything good about the US economy or about the equity market. It may be that people are worried that the US market is overstretched, valuations are too high, and they're taking refuge in gold, which typically provides a reasonable hedge when stock markets tank. Now, today's video is sponsored by NordVPN, and this is an app that lets you securely connect to the internet across all of your devices. I use it if I'm out on the road and I have to connect to my brokerage account and I want to make sure the connection is secure. Because one of the concerns is that people can create fake Wi-Fi networks. So you think you're connecting to your hotel Wi-Fi, but in fact you're connecting to some dodgy server. Now, if you use NordVPN, all of your traffic will be encrypted, so even if there is a man-in-the-middle attack, they won't be able to steal your passwords. Another way in which I use it is if I'm in a foreign country and I want to access the UK as if I was still in the country to play iPlayer movies, for example, I can still do that as if I was still in the UK. And because the servers at NordVPN are so fast, it never slows down my traffic. I can still stream as fast as I want. Now, if you have the NordVPN plugin installed in your browser, here I'm using Chrome, connecting to NordVPN is very easy indeed. I just click on this icon and then I can choose which country's servers I want to use. I could use one in the US, but in this case I'm going to use one in the UK. And that's it. I'm now connected and all of my traffic is now encrypted. And if I was in a foreign country, it would look as if I was logged in the UK. Now, viewers of PensionCraft get a special deal from NordVPN where you get 4 months free. To make use of that, just go to the URL nordvpn.com/pensioncraft or use the link in the description below. And remember, that comes with a 30-day money-back guarantee. So will gold crash now? Now, forecasting a crash is impossible. We'll never know whether gold is going to fall over the near term. Certainly, if we look back in time to when gold surged very rapidly, it wasn't long until it started to fall very sharply as well. What we can't predict is how long it's going to carry on surging before it turns around. Now, if you look at data from the World Gold Council, and of course they're bullish on gold, you can tell from the name, but they make a good point, which is that if you look at the ownership of gold via ETFs right now, it's much lower than it was in the previous spike that we saw in 2011. So if you look at the gold share of assets, that would include things like equity, for example, and also bonds. In 2011, it was rising very sharply, and that's kind of what you'd expect. Lots of retail investors buying gold and pushing up the price. This time around, what we're seeing is a fall in ownership via ETFs. So the argument by the World Gold Council is that there's more room for a rally as more people pile into the momentum that we're seeing in gold right now. And I think that's a reasonable argument. But I think there are other reasons why the price of gold could remain elevated. Geopolitical risk is a big one. When people are scared, they buy gold. And a lot of the news headlines we're hearing right now about escalation of wars in the Middle East, but also in Ukraine, are very scary. So if those do escalate and things get worse, then I think gold could be potentially quite a good hedge against that pullback in risk appetite. We've also got a US election coming up, and that's usually a source of uncertainty. Whoever wins, it's likely that we're going to carry on these trade disputes with China, which could potentially escalate, and which will probably act to weaken the dollar and keep interest rates low, both of which are good for gold. And then finally, if we do see US disinflation carry on, then of course the Fed will start to cut rates eventually towards the end of this year, and that would be also a good story for gold. So if you think the price of gold is not going to fall sharply and you want to get exposure and you think there's further upside, how could you go about buying it? A great resource for finding funds to do a particular thing like track the price of gold is Just ETF in the UK and in Europe. Here you can see their list of gold trackers, and the expense ratio on some of these is very reasonable. For example, the X Trackers one is only 0.11% per year. One thing to watch out for is that if it's not denominated in pounds, then you may have to pay a high conversion fee on your broker's platform. The way to check that is to drill into the fund, click on the stock exchange section, and then just check whether it trades on the London Stock Exchange in sterling. In this case, it doesn't. So let's try this one from Amundi. And here you can see that it does trade in sterling on the London Stock Exchange under the ticker GLDA. So you can buy these gold tracking funds relatively cheaply. Another way to get exposure is via gold miners. The beauty of getting exposure that way is that they pay a dividend. So instead of a storage cost, you get the equity risk premium and you also get an income. Miners tend to pay high dividends. However, it's not such a good hedge against stocks falling because you're buying stocks. So there are reasons why people go for pure gold exposure via funds which buy gold directly. Another way to buy gold is via physical gold. And one of the things that the Royal Mint website tells us about buying physical gold, which is also classed as legal British currency, is that you don't pay capital gains tax on it. So they say if you buy gold and silver Britannia coins, sovereigns, and the popular Queen's Beasts range, they have a capital gains tax exemption. But there you will have to think about storage, safe storage, and that comes with its own costs. And this is a less liquid investment than something like an ETF. But certainly some of the pension crafters do use those gold bullions and make use of the CGT exemption. So I think gold is a reasonable hedge if you think things are going to get a lot worse, either because debt spirals out of control or because equity markets are going to fall sharply. But the thing to always bear in mind is that the average return on gold is not particularly high. It does tend to just track inflation. So for example, if we compare the price of US stocks, and this is total return, so I'm assuming that for stocks you reinvest the dividend and for bonds you reinvest the coupon. For US stocks you'd have averaged about 9.1% return since 1871. For US treasuries much less, 4.6%. And for gold you'd have made about 3.2% on average over that period. Now the value of the dollar was pegged to gold for a large part of that period, so the return was by definition zero. But what you can also see is that over the long term, it's not much above inflation, even after the relationship between the dollar and gold was broken. So you will on average underperform if you hold gold, although there is a case to be made that by diversifying, by reducing your losses during the sharp drawdown periods in equity, gold does boost your long-term return. Plus, psychologically, many people find comfort in the fact that they've diversified across another asset type beyond bonds and beyond equity. Now, personally, I don't hold gold. I might do in future, who knows, but it would probably be a fairly small holding. And I'm certainly not de-risking at the moment because of my worries about what's going on geopolitically or with the US equity market being overvalued. But if you are worried about those things, then I think gold is certainly something to consider at least as part of your portfolio. Now don't forget our offer from NordVPN. You'll get 4 months extra if you use our special discount code. You can either go to nordvpn.com/pensioncraft or look at the link in the description below. And as always, thank you for listening.